A global infrastructure boom is here, with trillions being invested worldwide. But when a contractor defaults, finishing an unbonded project costs a staggering 85% more. This construction boom magnifies risk with inflation, labor shortages, and supply chain chaos. This perfect storm is straining the entire surety ecosystem, making claims more frequent and severe. So how is this immense risk managed? We'll show how reinsurance shapes the best practices needed to survive. First, the basics. A surety bond is not insurance. It's a three-party guarantee protecting the project owner from contractor failure. So where does the money come from to back these massive guarantees on billion-dollar projects? A layer of protection most never see. This is where GUARANT Reinsurance enters. Reinsurance is insurance for insurance companies, letting sureties transfer catastrophic risk. Significantly, the market is shifting. Regulations like Basel III make bank-issued letters of credit less available, pushing projects to surety. Reinsurance is indispensable because it expands a surety's capacity to underwrite massive infrastructure bonds. It also provides capital relief, freeing up the primary surety's funds, and it diversifies risk across a global financial pool. Without reinsurance, the surety market couldn't support today's large-scale projects. Primary carriers would turn down bonds, stalling development. How does this financial backstop lead to better claims handling? It's not just about money. It's about creating operational stability. Imagine a surety's finances without reinsurance. One large default could erase years of profit, creating pressure to deny or delay valid claims. Reinsurance acts as a shock absorber. By ceding risk, the primary surety's maximum loss is capped, permitting a consistent claims philosophy. This stability empowers the claims department. They can engage early to mitigate losses, fostering a culture of problem-solving, not just cost-cutting. But if reinsurance creates such a strong backstop, why is the market hardening and claims scrutiny increasing for contractors? The economic climate is working against stability. Inflation drives up material and labor costs mid-project, raising bond values and default risk. We are seeing a canary in the coal mine, a sharp rise in payment bond claims. This is a classic warning sign of cash flow distress. This is not a domestic issue. The G7's pledge of $600 billion for global infrastructure puts further strain on the world's surety capacity. Because of these pressures, sureties are forced to be more conservative, demanding more detailed financials and making it harder to qualify. We see the market tightening. Now let's look behind the curtain. The pressure isn't just from contractors, it's flowing down the risk chain. Here is the answer to our question. The market is hardening because reinsurers themselves are reacting to the increase in claims activity. Due to rising global losses, reinsurers are demanding primary sureties keep more risk themselves through higher retentions and lower commissions. This directly impacts the primary surety. With less profit margin and more risk, they have no choice but to be more selective in underwriting. This is the critical turning point. This top-down financial pressure forces an evolution. To remain profitable, sureties must master risk mitigation. So we've established the problem and the pressures. How does this environment create best practices? This is where reinsurance becomes strategic. Recall the market pressures making underwriting harder? That pressure, initiated by reinsurers, forces primary sureties to adapt to survive. This need for efficiency is accelerating technology adoption. AI and digitalization are now necessary tools for superior data analysis and claims processing. We also see structural adaptation, like using captive insurance companies as a reinsurance layer for better capital and risk management. This pressure elevates proactive strategies. Early communication and diligent record-keeping are championed to prevent the costly defaults we saw at the start. The infrastructure boom created unprecedented risk. This stressed the surety market, causing reinsurers to tighten financial terms. That pressure became the catalyst for the very best practices, technological, structural, and procedural, that the industry needs to thrive. For contractors, this means proactive communication and strong risk management are no longer optional. The system's financial backing demands it. In this age of infrastructure, success is about building resilience. That resilience is forged in the partnership between surety, contractor, and reinsurance.